Hi, everyone. Thanks for joining us here at Industrial Exchange's webinar, Basic or Bespoke, Negotiating the Best Insurance Deal for Your Needs. This is the second insurance-focused webinar we've administered here at Industrial Exchange, and we found the topic to be of increasing relevance to our network over the past several months. Before I introduce our panelists and moderator, I wanted to address a couple of housekeeping items. First, for everyone's collective listening experience, you will be muted. You are free to ask questions at any time using the questions widget that is part of the GoToWebinar application on your screen. We will allocate about 15 minutes at the conclusion of today's webinar for Q&A. Additionally, we will make a copy of this webinar available for download shortly after the conclusion of today's session. Okay, now for today's topic. It's safe to say that the world is considerably riskier today than it was before the onset of the COVID-19 pandemic. But many of the changes influencing the insurance market were set in motion long before the pandemic ever reached the US and are likely to reverberate throughout the market for years to come. In our first insurance session, you heard from the carriers. Today, we're here to give you a broker's perspective. To do so, we have three industry-leading voices to share their insights with you. Mike Rice serves as Chief Executive Officer for CAC Specialty. He brings more than 30 years of experience in the brokerage industry. Mike is a member of CAC's leadership team and is also a board member. Prior to joining CAC, Mike most recently served as the founding CEO and executive chairman of JLT Specialty USA, responsible for overseeing JLT's US specialty operations and expansion. Prior to joining JLT, Mike had several senior positions with Aon over a 25-year career. Matt Miller is the founder and CEO of MBroker, a digital-first broker and insurtech company. Prior to founding MBroker, Matt was a principal at the private equity firm Hellman & Friedman, where he led investments in the insurance and software space. While at H&F, he served on the board of directors of Hub International, Applied Systems, and Renaissance Learning. Prior to joining Hellman, Matt was a VP for Bain Capital in Boston and Hong Kong, and a consultant for Bain & Company in New York. Moderating today's session is Industrial Exchange's friend and insurance expert, Joe Coughlin. Joe has over 30 years of experience in the consulting, advisory, underwriting, and brokerage segments of the insurance industry. Over that time, he has originated thousands of engagements and provided services for many of the largest and most intricate transactions within the PE and distressed debt markets. We're pleased to have Mike and Matt with us here today. And Joe, please take it away.
Hey, thank you very much, John, and thank you to the Industrial Exchange for providing us with this platform to discuss this timely topic. During the course of the discussion, we're going to have a chance at the end, as you heard, to ask questions from the audience, and we're also going to be asking a couple of polling questions that you'll be able to give yes, no answer to that will be taking place during the conversation. So what I like most about the Industrial Exchange, though, is that its willingness to explore topics and provide its members and participants with some knowledge that's out there, and the commitment to providing that knowledge to today's business platforms. So that said, I'd like to start with a couple of first some points to just provide a backdrop for the conversation. So one, the topic today is somewhat misleading in that there's nothing basic that's about either these panelists or that the business that they're in. Insurance, by its very nature, is very, very complicated because it involves, in its essence, a contract. And contracts, as we all know, have words, and words have meanings and different interpretations. And when those interpretations conflate with each other, you have what ensues normally is called litigation. So let's start with that as the first premise. Second, the insurance industry is huge. It's gigantic. It has some $6 trillion of insurance premiums that flow through annually. There are some 2,500 plus insurance brokers in the property and casualty space alone. The slide that you're looking at here shows that the top property and casualty underwriters in the United States, this is as of 2018, it basically holds up today, but you have State Farm representing approximately $65 billion in collected premiums. And at the bottom there, you see Nationwide. Now, it also correlates that State Farm right there only represents 9.3% of the market, whereas Nationwide represents 2.6% of the market. So just gives you somewhat of an idea of what's involved there. There's also some 1.2 million brokers that are involved with this space. And so I would like to also take this slide to just talk about some of the immense amount of IT that is involved here in order to provide this, the insurance companies and the rates and the services they put out here. State Farm is on its own. Forget about the other 2,500 plus property and casualty insurers that are out there. Has a library that it collects some 10 times the amount of information that the Library of Congress currently collects and stores. So multiply that out over many different platforms, and you can see the immensity of the industry. Thirdly, for an industry that's been around for 300 plus years, back to the Lloyd's of London's days, you can make the argument that very little change has taken place in the commercial market space, and that what influence has taken place, or what changes have taken place more recently, have been as a result of some of the changes that took place from insurtech companies, venture capital platforms that have moved the private market, the personal market, auto and homeowners insurance, to be more user-friendly. But there's still a very big opportunity to try to disrupt the commercial marketplace, but it's very complex. Fourth, we are in absolutely the worst, hardest marketplace that we have seen in 40 plus years. There have been 3 other market cycles that took place: 75 to 78, 84 to 87, 2001 to 2004, and now starting in September of 2019, we've entered into this market cycle, which is has hit as a result of a whole host of things, not the least of which are the catastrophic claims. And if we could just go to, let's go to what we've seen in the market. If we go to that next one, Rob, that next slide. This basically just takes the axis on the bottom with the years. You can see where these dips took place in the market, and you can see that where it's highlighted in yellow, some of the losses and some of the hurricanes or typhoons or tsunamis that have hit respective countries around the world. But that accounts for what has seen with the property pricing has gone down, and now as you see that axis that's starting to trend up with the dotted blue line, that's where we are today. And if we can go to the next slide, Rob, this is what's driving this catastrophic claims that you're seeing here. These are climatological claims that are in floods and earthquakes and windstorms that have taken place, and you can see that there is an influx. So whether you're a believer in climate change or whether you believe in global warming, the one thing that we can say is that there are events that are affecting this industry, and they are massive. On top of this, we have other issues that are driving this expense. There is the Me Too movement, which saw some 400 executives removed from office, and the ensuing litigation that took place there. We are at an all-time low of interest rate environment, with some countries in Europe actually having negative interest rates, which people thought to be absolutely impossible and anathema to ever even being able to exist. So we have that's going on. We have social justice claims awards that are hitting every area of the market. And so this is the backdrop that we start this conversation with. And if we could just go to this next slide, the continuum here. Oh, and this, but go back to that a second again, because at the end of the day, this is Hurricane Michael, which is just one of thousands and thousands of pictures you can see of the devastation that each one of the insurance companies ultimately is backing up, and people, I think, sometimes lose sight of that. So if we can go into the slide of the continuum, on one side, I put this here and just saying the continuum is defined as a range of things that are slightly different from each other. So on one side, on the left side, you have M Broker, which is Matt, and on the right side, you've got Mike, which is CAC Specialty. So each serves, in some places the same exact constituency, and in other places, entirely different. So when we thought about having two participants in this platform, they really represent just a wide range and the spectrum. So if that said, I'd like to say, both of you guys are very entrepreneurial in the decisions that you've made about your careers. Matt, if I could start with you, what made you, given some of the backdrop of what you know about insurance, so you know about the brokerage industry, having served on the board of directors of Hub, and knowing what you know about the marketplace today, what brought you to MBroker and founding that platform?
Yeah, thanks, Joe. And thanks everyone for joining. So in my experience, as Joe mentioned, I was on the board of Hub. I was an investor in that company. I was also an investor in software companies and had been investing in software companies most of my career. And I found that commercial insurance was just an incredibly interesting market. It was complex for all the reasons that Joe had mentioned, but when you got down to the core of the business, it's a business that depends on the exchange of information. And I think that at the time that I started the company in 2015, and even now, I was looking out and thinking about how the digital transformation of the industry was going to have a tremendous impact on how risk is priced and how effectively risk transfer can work. And that was, I think, an insight that many people have had. And it was really just a question of trying to decide on a platform that I thought would be a compelling opportunity to actually create and catalyze some of that change. And so MBroker really became that idea that I left and became very passionate about starting as a way to really try to more efficiently transfer risk. And particularly focused on both small commercial and lower mid-market companies, and find ways that you can build and use technology to make risk transfer a lot easier, a lot more effective, and a lot more efficient. And so yeah, it's been 5 years since we started the company, and I think we're making progress on a lot of the ideas that we've set out to do. And I think we'll talk more about that a little bit today.
Excellent. Hey, Mike, knowing you a little bit longer than Matt, you've been with a number of large brokers. You're now at CAC. You want to just give us a little background on the migration there and where you're headed today?
Yeah, thanks for that, Joe. Happy to do that. I joined CAC less than a year ago. We've only been in existence for about 11 months. The reason I joined CAC was a lot of things that Joe was just talking about, and actually the title of this presentation, the word bespoke is in it. And I'm a big believer that a lot of the big brokers have moved away from bespoke broking with large accounts, and they're trying to commoditize products beyond which makes sense for the actual buyers of the product themselves. So in joining CAC, we basically utilizing technology, knowledge, experience, and market relationships as a backbone, have built a broker that targets probably the 10 largest brokers in the United States. Probably not on the surface the smartest thing in the world to do, to go after that constituency, but we're predominantly going after the upper mid-market all the way up to Fortune 500 space. And we just think there's a great need in a hard market like this to have people that have seen other hard markets, are very consistent in their approach, lead from the front, use technology as a backbone for how they operate, and provide intuitive and innovative solutions to clients.
So you each offer, similar products. Let's just even take directors and officers liability insurance. A lot of people that are listening today are purchasing directors and officers liability. Matt, could you start off with what is a typical target audience that you're seeing with MBroker?
Yeah, so in our case, we've taken somewhat of a different approach in terms of the way that we go to market and build product. We actually operate both a digital distribution platform and a managing general agent. So when we build commercial products, we try to build them from the ground up. So we actually have a directors and officers program that we built from the ground up with a treaty reinsurance agreement on the back end, so that it insulates us to some degree from some of the market cycles we're seeing now, but it also provides a fully digital product. So we can underwrite and provide directors and officers quotes in less than 5 minutes to most any private company in the US. And that is just a radically different approach to the market, where we're trying to build technology in a way to make it significantly more efficient, significantly more cost effective for those companies, but also combine that with what we think is market leading coverages for those type of companies that need it. But for us, that target looks like, I would say, venture-backed technology companies are huge in market for us, as are kind of the lower mid market of private equity owned companies with revenues of anywhere between, call it 10 and a couple $100 million.
And Mike, your ideal target audience that you like?
Yeah, it's similar. I mean, Matt and I both play in the same space. I mean, we like venture-backed companies. We tend to pursue those that have IPO as a track. We particularly like private equity-backed companies. We tend to play in the larger market there. We will go down below 100 million in revenue very easily, but our typical market is a company that's more than $100 million in revenue and up. It's more of a bespoke platform. We use probably 50 different markets on the D&O side, for example.
Wow. And here's another one. I just it occurs to me that private equity and some of even VC from time to time gets a bad rap, but you both are enjoying your platforms as a result of this capital stepping up behind you. What do you think is driving them into this space? Is it the disruption, or is it the returns, or both? Matt?
Yeah, I would say it's probably both. I mean, I've been on both sides of it. Our investors are venture investors currently, and I think that insurance as an endpoint for venture investing has a number of attractive attributes, namely given, I think, the potential for technology to produce transformative change that significantly benefits the end buyer. So I think we've seen now billions of dollars each year going into insurtech companies across both personal and commercial lines, and that's a certain type of a bet. And then of course you have more traditional private equity roll-ups that I think have traditionally had really strong returns for the investors as well, and have performed well across the last couple market cycles.
And Mike?
I think on our side, I think it's the investors that are drawn to us are drawn to the potential cash flow that exists in the model. 11 months ago, we didn't exist, and we'll probably put $400 million worth of premium into the marketplace in our very first year. So it's being a disruptor, bringing about unbelievable growth. But I think the cash flow model of being on the brokerage side, as opposed to the very heavy requirements of being on the underwriting side, where you have to reserve a lot of capital, are the things that make us most attractive to our investors.
Okay, let me ask you this. Do you think that your clients now, has there been an evolution even in the last, dare I say, the last 8-9 months that you've seen with the sophistication or in the way that your clients are approaching risk? If I was to say that the last soft market made insurance almost a commodity, or at least people view it that way, do you believe that that clients now are waking up to the fact that this is serious and this is real, and risk transfer is a critical component of their business? Have they become more sophisticated, Matt?
I do think so, actually. Even with buyers that we see that are on the smaller end of the market, I think certainly the last 8 months has made people more aware of risk generally. And I think that we all have an optimism bias as a heuristic, and we don't think bad things are going to happen to us or to our companies, and that can make you, I think, less just feel that insurance, and especially the specifics of the insurance contracts that you may have, are less important than any of the other 100 things that you need to do as CFO of a company. But certainly when we see just things around that are happening that are scary in general, I think that it does increase the amount of awareness just of what contracts you have in place, how protected you are, what exclusions may exist, and just the quality of the products that you're buying.
And
Joe,
Mike?
we've noticed definitely much more sophistication with our buyers of insurance. I mean, you used D&O as an example before. I mean, D&O is a product that has a huge amount of involvement every single year. There's new case law being set every single day. There's new cases being filed every day. We're at record levels right now in the securities class action arena. And that's just talking about public company claims. There are a ton of claims coming against private companies. But I think if we've seen clients really want us to help them in 4 areas of their business. Number one, how do we impact their growth? Meaning if they're going to make an investment overseas, do they have an insurance contract that allows them to conduct business accordingly? We've seen them challenge us to make sure that our insurance contracts have an impact on the profitability. That's a real easy one. I mean, this is a big cost for a lot of companies, and the cost has an impact on the P&L. And so making sure that the cost is appropriate has a big impact on their EBITDA. And quite frankly, if claims not covered, it has a big impact on their EBITDA as well. So we get challenged a lot in growth and profitability, but 2 things that we've seen recently is in business continuity and in innovation. We've seen a lot of our clients ask for what I would refer to as next best alternatives in the insurance negotiation process of, I've been buying something the same way for the last 20 years. Is there a better way for me to consider doing it? And so that in its own right says that the clients are becoming much more sophisticated and that they're saying, I want to make sure that I'm thinking through all the options. I may not buy a new option, but I want to know that there's next best alternative. And then finally, on the continuity side, they want to make sure that they're going to be able to attract, again, back to D&O, a really diverse board and a consistent board. And the best way to do that is have really strong insurance coverage that the board can rely upon. So the business continuity part of this whole thing is really entered the equation. So yeah, absolutely much more sophisticated.
Well, before we'll ask a polling question after this, but as I'm listening to both of you guys talk, I can't help but be thinking about the fact that you and your firm, your people within your firm have to be, quite literally educators, because some of the information that's coming down the pike, regulatory wise alone, today we have ESG out there, which is environmental, social, and governance issues. We have the GDPR, which is the European model regarding privacy and issues that people have to conform to. You have CCP, which is the United States, the California Consumer Protection Plan, mirroring the GDPR. And so what this all boils down to, though, it's somewhere it involves insurance, which in many places was never planned or ever contemplated. So do you find that both of your platforms, you're spending a lot more time educating, your clients about the changes that are taking place? Matt?
Yeah, I think so. I mean, it's something that as there is more activity in the market, I think, we, serve more than 3,000 customers. And it's always the case that when there are major events, COVID being an obvious one, but beyond that, I think, some of the same things that you've mentioned, we see that as a good opportunity to provide education and to, help make sure that people understand what it is that they are covered for, what it is that where they might have exposure, how they might want to make risk management decisions in a different way. And I think that's increasingly, it's always been obviously the job of an insurance broker and a good one to do that. But I think as you start to see just a marketplace where it does feel like there are more risks, it does feel like those risks are changing rapidly, that it's an opportunity to really make sure that you're providing that service to your customers and doing so in a way that makes them feel that they understand the nature of the risk and understand what decisions they're making from an insurance perspective.
And
yeah, I think as Matt's saying, I mean, he's saying the same thing that we're saying. I mean, our clients are demanding the ability to make decisions based on fact, not feeling. And the only way we're going to do that as an industry or as a company ourselves is to educate. We view ourselves as an aggregator of information. We also view ourselves as a specialist. And where we play, we like to hire the best in the business. And it's incumbent upon us to educate what's happening almost daily at this point in time. And we pride ourselves on the ability to put out information to our constituencies daily, monthly, bi-monthly, quarterly, semi-annually, and annually. It's a very big part of our business. It also requires a really, really big investment and people and technology to do that.
yeah, let's go, Rob, if we could, to the first polling question that we'll ask the audience, if you don't mind. and that will come. Here we go. Do you believe technology has improved the procurement process of your business insurance? So it's a yes or a no. Do you believe technology has improved the procurement process of your business insurance? And business being the operational word in that sentence. Personal is one, but business is another. And if you could just simply hit yes or no, that would be terrific. And while we're waiting for the results of that, oh, here we are. So 76% of the participants or listeners believe that it does. It has improved the process, and 24% say it hasn't. I still think that we're skating around the margins on some of these improvement potentials. So I think that I like the optimism that exists there. So going back, let me ask a question that some of our listeners are listening to or would like to know, but do you believe that insurance should be shopped every year for your clients' needs? A lot of times people say, oh, we just shopped that a couple of years ago, or we just checked the market, before. But given not only the hard market now, but, how do you stay, contemporary, and how often do you think that you should be, taking a hard look at the client's risks and exposures? Mike, why don't we start with you on that one?
Yeah, I would categorically say that I don't believe insurance should be marketed every single year. The problem we have in many of the lines of business, when you're talking about business insurance, is we're not dealing in commodities. And too many products, you have too many carriers with too many different policy forms to really just look at the price and say, that's my best deal. Now, I will tell you this. I believe in a marketplace like we're seeing now, which is unprecedented in the last 25 years, with premiums going up between, let's say, 25%. And, you see some deals and horror stories out there where premiums are going up by 500%. Knowing that that's coming for a lot of folks that either have just renewed or are about to renew in the future, I would suggest, since the carriers are maybe changing the playbook a little bit, this would be a very good year to take a look at what's going on in your program. But you got to be really careful because, Joe, you mentioned all these things that are out there. You got the Me Too movement and the Black Lives Matter movement and things of that sort. It's having an impact on the way carriers are writing their policy language. And so you can't just look at the price. You got to look at the coverage. You got to look at the exclusions. And I will sign off with this. I'm a very big believer in continuity of relationships, particularly when you've got big policies out there with lots of limits and lots of exposure. And knowing that a carrier that you've done some business with, you potentially have some money in the bank with, is a very, very good thing and something you shouldn't forget about. But you really have no choice but to market things in today's market.
Matt?
Yeah, I would agree with what Mike said. I mean, I think that it is, not always in the best interest to market something every year. The way we approach it is we always use data to look at pricing, look at what we see in the market trends, and then try to assess like whether we have the placement done correctly or whether it is a good time to go out to market the policy. What we've seen also, with our own program is that it tends to, because of the efficiencies we build into it, like it tends to be the best option for price and coverage, but not always. And like where we see an opportunity to improve price or coverage by looking elsewhere, we always do that. But for the most part, like we've built something that, tends to be the best option for most of our customers. And so like we're happy to go look and try to market it, but we always want to make sure that we, at the end of the day, end up with a placement that makes the most sense for the customer.
Yeah, I think that's where your model is very interesting in the sense that you've got your MGA, your managing general agent, managing general underwriter on one side, and then you have the retail operation on the other. So if it doesn't fit here, you can take it out into another. You also you're the lucky beneficiary of having put your reinsurance, your treaties together that has taken you. It straddled this hard market time frame, which has been fortuitous for your client base, correct?
Yeah, definitely. I mean, I think that there's a couple things about the program that are relatively unique. I mean, we do have multi-year treaty reinsurance agreements in place with Munich Re, and so it's A++ balance sheet in terms of providing the capital. But the way that we built the product as well is actually, designed. We started with just a policy form that, for our target companies, we think is the best in the market, and we updated each year. As Mike mentioned, we see when we see evolutions to best-in-class coverage, we'll change it. But then the real thing is that all of the underwriting is done algorithmically, and so we build basically algorithmic underwriting that pulls a lot of data, and that offers the ability to provide, on one hand, real-time pricing, so that it takes only 5 minutes for companies to get pricing. And I think a lot of people assume that means that the product is in some way maybe not as good or not as complex. But I think, as you pointed out, it's not bespoke, certainly. And I think there are benefits in times where you need a bespoke policy, but there's other times where you need just a really, really good policy and really good pricing relative to the coverage that you're providing. And so by digitizing the entire process, we're actually able to provide, versus a competitive set when you just look at the cost and expense ratio, usually on the order of 20 to 25% savings versus other best-in-class coverages. And so all of that is relatively unique and relatively new, just in the way that we use technology from start to finish to actually provide the entire life cycle policy management to our customers.
Yeah, and Mike, on CAC's side, this is where I think it is definitely bespoke. I don't know how much you want to get into it and talk about it, but the platform that you have does involve situations where you can actually help with some of the capital needs of the client that you're finding at different times in the marketplace. Did you want to touch base on that at all?
One of the attractive things about me joining CAC is there was a plan in place to have an investment banker within our core insurance brokerage operations. That's not a real typical thing. I mean, you'll look at
not at all.
Some of the large brokers will have investment bankers within their reinsurance group due to the nature of the way they place some of those big reinsurance placements. But to have one on the kind of go-to-consumer business owner insurance brokerage side of the business and house is a very different model for us. So, we like to think that so much of the underwriting that goes in on a lot of the products we do, like D&O, involves financials and wherewithal and bankruptcy risk and things of that sort. And to the extent we can actually bring somebody else into the equation that can help people with short-term monetary needs, with debt financing, with potential for equity finance and things of that sort, it's proven to be really, really valuable. And quite frankly, the group also acts in such a way where they may go to traditional investment banking type markets and introduce insurance markets that sit on a lot of capital to help solve our clients' needs. So it's really unique. It's a really neat thing to have. It's early days, but it's playing out really well for us, particularly in light of all the difficulties people are having in light of folks working from home and having to furlough employees and conserve cash and things of that sort. So it's a real neat addition to what we're doing.
That's good. It's very interesting. You're right. We haven't seen that actively pursued in the market before, and it is. I think it's a very attractive feature to have, especially when you're walking in to a client that is just getting hit with a 50% rate increase, if not more, and also has some very big growth projections in light of COVID that they still need to achieve. So it can be very opportunistic in a good way. I screwed up Rob a little bit on the slides before, so I apologize for that. But one of the slides, and we don't have to go back to it, Rob, but was just in terms of the number of brokers that are in the industry, and it was like some 1.2 million. I was wondering if I could just get you guys to opine on some of that, because while you're doing your own disruption in your own space, there are a number of, I could probably name 15 off the top of my head, platforms that are consolidating, mostly led by private equity firms that are consolidating brokerage platforms. And what we've seen, Mike had just recently lived it. He was at Aon for many years, then went over to lead JLT, and then JLT was sold to Marsh for $5.7 billion. You're seeing that Willis is consolidating and merging with Aon. And there's more and more consolidations, mega mergers on the horizon. And then on the middle market, they're happening every single day, but yet year in, year out, the same number of brokers stay in the industry. And that's because of relationships. So I just wondered if, Matt, you had some opinions on some of these consolidations and where that either affects MBroker or you find it interesting.
Yeah, I mean, I certainly find it interesting. It's
stupid question. Sorry.
I spent a lot of time on looking from the investment side. When I was on the board at Hub, we did 84 transactions during my 2 years there, and
Jeez.
I think one of the things that's interesting about it is when you and this was always fascinating to me, is like when you look at the way when you buy companies, it's treated on the balance sheet as you have a bunch of goodwill and you amortize it, and that's the accounting treatment. But it's actually accurate because you buy these relationships and year over year they usually become less valuable because every year people are 1 year closer to retirement, and so you have this asset that you're buying that's a depreciating asset. Also with the connotation that because you have this asset that are the relationships, you are monetizing them, and so like you are over monetizing your relationship with somebody, and that's just a weird way to think about it, but that's why brokers run such attractive margins, because they get paid a lot to monetize their relationships. I think that one of the animating principles behind this was the idea of like, what if you took that capital and rather than investing it in a depreciating asset, which are relationships, you invested it in technology that over time has economies of scale and benefits and can actually create more structural change. And so I think that it's been a great model, the roll-up strategy. I think it'll continue to make people money. But if you look at a 20 to 30 year time frame, I think that what you'll see are new dominant players that take a very different approach to the use of capital and how you think about investing in innovation and investing in more structural change.
Mike?
Yeah, I was looking at the list of the top 75 brokers for the year just about a month ago, and it is dominated by brokers that have built themselves on an aggregation strategy, which is a number of acquisitions a year. And I will not follow Matt by talking about acquisitions because he's truly an expert in it. And I'm on the other side of the house. I'm very much into organic growth. There aren't a lot of brokers that choose to grow organically. My personal belief is acquisitions are great if it can actually make you better on what you offer to your clients. And that's really where our focus has been. So as it stands right now, our strategy within CAC especially will continue to be an organic growth strategy. We will use our capital to invest in technology where it makes us more efficient and to acquire the best talent in the industry on an individual basis, as opposed to making acquisitions of companies. But it's something we'll certainly consider doing in the future. Like I said, if an acquisition makes us better and allows our clients to add something else that's going to make their insurance purchasing simpler, we'll absolutely consider doing it.
Okay. Rob, can we go to the next polling question, if you don't mind? Okay. The question is, do you converse with your insurance broker during the course of the year for reasons other than a claim? Sounds like Jeopardy. Do you converse with your insurance broker during the course of the year for reasons other than a claim? Just simple yes, no question. And while we're waiting for that, I'll just go into some of the the shifting appetites that we're seeing. Okay, here we go. Yes. Wow. I'm surprised. 71% of the audience says that they do converse with the broker other than a claim. 71 and 29. Very interesting. What do you guys think about that? Does that sound right to you? Quick answer, yes, no, Mike, Matt?
Absolutely. I mean, with us, based on our segmentation, maybe a little larger in the scale, I would say it's probably 100% of the clients we have continued dialogue with over the course of the year, especially with the requirements of a renewal cycle. A renewal cycle implies that you've got a lot of steps that have to happen over the course of the year. In a hard market like this, you have to be speaking continually with your clients.
I agree.
Yeah,
Matt?
Yeah, I would agree. Although it's interesting because the implication there is that that's always a good thing. There's probably a lot of cases where people are speaking to their brokers where they really don't need to be, and so it could be just reaching out, or it could be dealing with a certificate, or trying to get like policies or something that actually would be much better handled through a technology platform. But it's not exactly clear. That could be people providing education or guidance, or it could be just somebody needing to deal with some pain in the ass thing and not having a better way to deal with it. So could go either way.
No, yeah, it's true. There's a lot of you could use. There's probably 3 or 4 different nuances to that question that give you to different places to interpret it. Let's we're going to open it up in a minute to some other questions, but I just want to go back to the shifting appetites of the carriers right now. And what we're seeing, at least with some Lloyd's syndicates over in London right now, is they're starting to come out with some new exclusions. And while there were pandemic exclusions that were put in after SARS, a few years ago, and while there is contamination, clauses, and the way civil authority, commotion has been handled in the past, strike, riot, and civil commotion exclusions are starting to be incorporated into certain policies. Do you think that will gain traction and become more institutionalized across insurance markets, or do you think it's just a reaction that is meant to fit the immediate times? Mike.
Yeah, I would 100% in a market this hard of the time, you can expect that carriers are going to try and limit the amount of coverage they're offering. And they're not doing it because they think they're going to lose money. They've been losing money for a while now. And the frequency of claims is pretty large. And so this ties back to that whole concept of, do you market your program right now? You've got to make sure you keep broad coverage. I'll give you an example of this. I was on the phone with a client the other day, a prospect who's now a client today, having a conversation around their employment practices liability coverages and D&O coverages. And they had a combined lines program, Joe, and within the program, they were being told that the carrier wanted to make sure specifically that the client knew that despite it was one aggregate limit of liability in a combined lines program, that the D&O wording applied to the D&O policy and the EPL wording applied to the employment practices liability policy, which is pretty typical. And oh, by the way, there was going to be a coronavirus exclusion. But what happened, and I think unwittingly what happened in the contract, was on the D&O portion, where it's very typical in a standalone D&O policy to have coverage for employment-related matters, where they name the directors and officers, they basically were saying if any employment-related matter involves coronavirus, it's not covered under the D&O portion of the policy. That wasn't the intent of anybody doing it. It was an outcome of having a combined lines program and somebody trying to be clever about explaining how and what was supposed to be covered on what portion of the policy. So adding the coronavirus exclusion on one side of the policy on a combined lines program actually added the exclusion on the other side, and they lost a significant amount of coverage. So Joe, these are coming. They're out there. Carriers are going to try and limit their exposure in many, many circumstances. This is particularly within the bespoke marketplace, and therefore, you have to utilize your leverage, whatever leverage you have, whatever the leverage your broker has, to go into the market and make sure that you find the coverage offered by somebody else in order to push back against your incumbent carrier.
Yeah, I would agree. I mean, I think what we see are, not necessarily exclusions, relating to, specifically strike and riot, but just normal exclusions that carriers try to get into policies and that kind of make their way back in. And so we see, like on the D&O side, bankruptcy exclusions and creditor exclusions and major shareholder exclusions, things that, brokers should and will try to get rid of, kind of making their way back in. And I think that's one way in terms of our approach, that we've built a coverage form that we stand behind, that we think is best in market, and then it doesn't change. And so that, like, the benefit of that, not only is it more efficient, but that as you have things around the world, like people that are, maybe rescinding or pulling back coverage, that you can offer a product that people feel very comfortable. That's like, okay, this can be compared favorably, and none of these exclusions make their way in, because ultimately it's as Mike pointed out, carriers are trying to restrict coverage to try to gain back some of the profits, but it's important from a customer perspective that you just really understand whether there are exclusions in your policy that could adversely impact you.
Let me ask you, by the way, we're opening this up to questions from the audience. If they would like to, just go into the chat Q&A feature there, and feel free to put that in, and we'll try to get it up there. In the meantime, I just want to go back to the thing that the product line you guys both prominently featured in, which is the professional liability, the D&O, directors and officers liability, and to go back and Mike, you had said there was an unprecedented level of claims activity that took place, and there was an article in the Wall Street Journal last week, which is talking about U.S. premiums for directors and officers insurance jumped 44% to 104% on average in the first quarter. Compared with the year earlier. And that's in the US and Australia in this particular article. So I'm going to go back, and then I want to also say that there was some 428 SEC claims that originated and were filed in the United States. And again, regulatory-wise, this was a change that no one ever had anticipated a couple of years ago, when you could sue not only for SEC securities claims in federal courts, but you now could sue in state courts. So that meant you had really two claims going at the same time, burning the limit twice as fast, potentially. So, Mike, comments, further comments?
Yeah, no,
about that?
I have a lot of comments on that, Joe. I mean, so two things you should be aware of. I mean, we track rates every single month. I know Matt does the same thing, but primary rates within the commercial buyers sector of business insurance in the month of May on a primary basis across all carriers were up by 38%. Excess was up by 62%. The composite rate was up by 55%. That continues. The high mark was in the last year was really set between February and May of this year. It could even be higher in June. When you look at financial institutions with it as a subsector within D&O, rates in the most recent were up both primary and excess by about 27%. The high point was in December of last year. But there's a reason for this, Joe, and the reason is this: D&O rates move as it happens within public companies, even if you're a private company, because all the carriers that write private company D&O insurance also have very large and substantial public company books of D&O. If you look at the claim numbers, if you look at the 5-year average number of claims that have come in against public companies right now, and you basically say, I'm going to have a historical year of dismissals at say 50% or 45%, I'm going to get the average size settlement, I'm going to have the average defense costs in a program, and you look at the number of public companies that are out there to date based on how much they pay on average, we would estimate there's about $6 billion worth of premium in the public company marketplace right now, just in the US. We would also estimate that there's about $5.68 billion of costs, insurable costs, tied to just securities class action suits. That doesn't include derivative suits. It doesn't include other state court actions. It doesn't include non-securities litigation against these companies. And so you see, and this is based on 12-month-old data, but you can see there's a problem going into this year. When you start looking at what's going on with coronavirus, and you see the number of bankruptcies that are happening within our economy right now. And by the way, Matt raised such a great point on bankruptcy. On D&O, you can't buy a D&O policy with bankruptcy exclusion. I mean, one of the most significant gaps in indemnification owed to directors and officers is bankruptcy. You go bankrupt, and technically your company can't pay for your litigation. And companies that go bankrupt tend to get sued by investors. And so the D&O policy is intended to step in on that gap in indemnification. If a D&O policy is now excluding bankruptcy, one of the main reasons you're buying the contract has now been taken away. So this is stuff that has not been priced high enough for the last few years. The claims activity is at enormous levels. The severity of the claims is at all-time highs. Defense costs are enormous, and it's a market that just hasn't been healthy. So we're not only seeing the prices go up, but we're starting to see the coverage pull back, and that's a very dangerous scenario.
Yeah, and I would add, I would definitely agree with all of Mike's points. I think what's been interesting for us is that because we only do private company D&O in our program, and so we've avoided kind of the major part of the exposure of public company D&O, and we tend to focus on companies that are pretty clean in terms of risk perspective of having limited loss history. And so because of that, we can drive excellent pricing on good coverage. And so we've actually, the way that carriers price it is they do take large private D&O increases to try to cover, some of the losses that they're going to have overall in the book. So we've had actually a couple smaller mid-market PE companies come to us and reprice their whole portfolio and see 40 to 50% cost savings on superior coverage, just because they're getting priced like everyone's looking at pricing across the book, and we're able to drive that because we focus on pretty clean risk that avoids a lot of the shareholder losses that you see in public companies. But that's just that's our approach, and our focus is focusing on that. And I think that it doesn't diminish the need if you're a public company to have that coverage in place. But certainly there are a lot of private companies now, I think, that are going to be significantly overpaying just because carriers are taking rate and trying to address losses on the other side of their book.
So the old days of cash flow underwriting, where you would sit and say, I'll collect the premium today if I'm an insurance company, and it might be years before I have to pay it out. If you've already got those reserves, as you say, Mike, $6 billion collected in, in premiums on the D&O side, but what'd you say, $5.6 billion that's already reserved on the side. I mean, there's no room for sunlight in there. It's a pretty dark glide path, or there is no glide path. You're hitting the wall there. I just want to go to a couple of questions, I think. CAC's platform utilizes risk-taking capacity from both the insurance and private capital markets. Given the hard market, would it behoove other brokerage firms to follow that model and take advantage of the convergence over the next few years? Good question.
I think they should all continue doing it the way they're doing it now, and let us just do it this way. Does that answer the question? Listen, I can't tell you what I think other people should do. I mean, other people have very large, significant books of business, and I think they try and focus on doing things the best they can and the way they want to do it. We're trying to bring innovative solutions into the insurance brokerage arena, and for us, that's a convergence of capital markets with insurance markets.
Okay, Matt, anything to add on that? If not, I've got a question for you.
Please, go ahead. Yeah, sure.
Okay. This is from the audience. What is a product, and this will apply to you, Mike, potentially, but what is a product that you are seeing in this marketplace that is likely to become more popular for middle market companies post-COVID or during COVID? What changes? What other things are you seeing? Innovations?
Yeah, I mean, I think there will be innovative products that will come out. We haven't seen, I think, a lot of them yet in terms of companies trying to buy coverage specifically for, pandemic or business interruption that would cover this. I think it's right now not really an insurable risk from the perspective of the carriers for the most part. That said, I think actually EPL is a policy that companies are going to be paying a lot more attention to. Employment practices liability. I think there's a whole series of questions that have yet to be answered on how employment-related claims are going to be litigated in this world. And so it's been a kind of hot button item. I think it'll increasingly be a hot button item. And so I think companies just both on D&O and EPL side making sure that they have not only adequate limits, but really, really tight coverage that protects them from any number of potentially employment-related issues that could arise out of this.
Okay, another question has just come in. Will data-driven artificial intelligence application uses in development of new risk protection products flatten the pricing and coverage issues? For instance, the advances in parametric covers. So, Matt, you want to take that?
Yeah, I think absolutely. I think it is one way in which, if you think about how data-driven pricing works, I mean, the parametric component, I think, is a part of that, where it is, I think, an effective way to reduce loss adjustment costs in certain scenarios, and will continue to be as people invest in that. But I think in general, getting to data-driven underwriting and algorithmic underwriting will help flatten the cost, because it just takes money out of the expense ratio and puts it more towards actually paying claims. And when you look at the expense ratio for commercial insurance overall, compare it to personal lines, you see just a 20 to 25% delta, and we'll be headed there over the course of the next 10 years.
And Mike, before I do that, just for the audience, when I think of parametric, I just think of binary. The loss either happened or it didn't. And I think crop insurance is one of the best. You had a 10% destruction to your crop or your fields, that could trigger a full loss. So parametric is almost limitless in terms of how you design the product. It just basically, what is the claims trigger? But Mike, what are your thoughts about? I mean, everything seems to be data science in every industry, and that's why technology is going the way it is. That's why with the interview with NASDAQ, some of the IPOs that are coming out. But what are your thoughts on?
Well, I think that's why you get the two of us up here today talking about what we're doing as two new companies. I mean, for us, artificial intelligence, data coming from our technology platforms are really, really significant plays. I mean, not only do the carriers need to utilize it to cut their costs, but we as brokers need to do that too. I mean, we'd much rather use artificial intelligence to download policy information than use individuals to do it. We'd rather have individuals servicing our clients. It'll make us much more efficient that way. So I think those that don't invest in technology, those that don't understand that data is not just about disparate data sets, it's about the insights and knowledge you derive from it, are going to hurt badly in our industry, and you're going to see a sea change in the leaders in the future. I think that's an absolute that's going to happen if people don't invest in technology and data.
Well, in a final point, I would just like to remind the audience, and one of the things anybody who knows me has probably heard me say in a meeting, but when you really come down to the insurance industry, it's always been guilty of using acronyms, and the one that I like the most is TEAM, and it's really the 4 ways that you can handle risk. You either transfer it, you eliminate it, you accept it, or you mitigate it, right? So you both serve a constituency that has the ability to either accept all the risk that they have for being in business. And we know from previous seminars and forums that we've had here is that 91% of the audience believes that they need to incorporate risk transfer into their insurance, platform. So when you think about team and you're transferring it to a third party, which is the insurance company, it really plays such a vital role. And I just wanted to say, I think it's with all these mega mergers that are going on, it is very heartening to see. And I say that in as being as genuine as I can, working with firms that are on, I don't care if we're on either side of the spectrum, but they're out there and they're making a move, and they are moving the industry in a place that would have been static otherwise. So it might be, chipping or, gnawing on the edge of multi-billion-dollar platforms. But I just wanted to say thank you to both Matt Miller from M-Broker and Michael Rice from CAC Specialty, and urge you to contact them with any needs that you may have, because they're both really good guys. So thank you to Industrial Exchange again, and thank you to our audience for listening in, and we will see you in the future.
Thanks, everyone.
Thanks, Joe.
Thanks a lot.
Everyone.
Okay.
Bye.
Bye-bye. And we finished right on time.
That's great. Nice work, Joe. Nice work, Mike. That was good.
Yeah, well done.
Thank
Matt.
you. That was a lot of fun. I think that we're signing off. I don't know if you guys